Ladies and gentlemen, welcome to the show. This is Trucking with Authority on the You Drive You network. It's been a while, and it's been a little longer than we planned by about 30 minutes. I think we are up and running finally on YouTube. We did have to drop the phone stream, but we're live here on YouTube. It's been about 6 months since I've done a live Trucking with Authority show. Unfortunately, we cannot take calls tonight. We had some major technical glitches. For those of you watching on the technical glitch number 2. For those of you watching on the YouTube stream, please leave a comment. Let me know how it looks, because I thought it was my fault, but apparently it's on the YouTube side. Some glitch over there. So we're streaming correctly now. We're up and running. I've got an important show tonight, which is why I wanted to push on with it, even though we are about half an hour late from what I had planned. Swimming with sharks, surviving in a competitive market. Over the past 6 months since I've done this show, the market has fallen apart. For those of you that are watching, give me a comment, some thumbs up. Let me know what's going on. I want to make sure that the stream is finally getting out now. Let me try to follow along here as we go. We'll give it just a few minutes to let some people get in here because we are late. Share this out. Let people know that we are live. We're supposed to go live at 7, and we got bumped a little bit. So we'll give some people a few minutes to come on in. Let's see if it's working. Looks like I see myself on the screen, so we're good. Working now. All right. So we're up and running. It's been 6 months since I've been on the show. The market has changed drastically. So obviously, it's all my fault. I apologize if I stop doing this show. The entire transportation trucking industry just falls apart, and apparently you all can't do this without me every week here. So I'm back so we can start picking things up again. I'll take all the blame for not being here. Why not? I can take it. So I'm back. Obviously, the market will start picking up. Things are going to start rocking and rolling again. Here we go. How do we survive in this market? That's what we want to talk about tonight. How do we swim with the sharks and come out on top? There's some important things that we need to know. Last year was a phenomenal year. It's been about a year ago we saw the highest of the highs, the peaks that were setting records. It was about May, June, and into July, and then as we went through after the 4th of July holiday, things started to drop off, slowly tapered down through the end of the year. And first quarter 2019, we really saw things change, and it did not pick up in the spring as we thought trends typically show that it would. We're still mid-spring, early spring now, but things should have already started to show a little bit more of an uptick than we've seen. It's holding off. Usually the week following the Easter holiday, you start to see those trends starting to inch back up, and we're not seeing it yet. So why is that? There's a lot of doom and gloom out there. There's a lot of talk about how the economy is tanking. There's a lot of talk about how horrible things will be. We've got people on one side talking about how the economy is falling apart and it's going to destroy the trucking industry, and we've got other sides talking about how the brokers are the problem, taking all the money, and we've got the shippers are cheap, and it's a lot of nonsense. It's a lot of speculation. It's a lot of blind-sighted thinking. A lot of people are focused on the wrong aspects. Right now, we're still seeing huge growth in the GDP, which means the economy is still cranking. We're still seeing job numbers that we haven't seen this unemployment in still over 50 years. We're still seeing fantastic volumes of freight. Matter of fact, currently, right now, even though rates are down, Right now, we are moving more volume of freight, more loads than we have seen move in the past 3 years this time of year. So it is currently, technically, a better market now. The economy is better now than it has been in years, in decades. We're moving tons and tons of freight. Loads are out there, but we're not seeing it on the spot market. And why is that? On the other side of that, what we do see on the spot market is super cheap, and trucks are sucking it up like crazy. Why is that? We've got two sides of this here. First of all, if the loads are there, why are rates down? And why aren't we seeing it on the spot market? So that should tell you something right there. If the volume is there, but we're not seeing it on the spot market, where could it be? It's been put into contract rates. Right now, the contract rates, the contracts are pushing the volume of the freight. We're not seeing it on the spot market. The majority of contracts were locked in early last year and into the middle of last year. Typically, a lot of the contract negotiations happen around the August timeframe. If you think back at some of the indicators just within the trucking industry, we had the ELD mandate that really took effect at the end of 2017, but took hold and changed the market in the beginning of 2018. That was a part of it. We also saw some economic things that really boosted the economy. Huge volume. We saw a lot of factories reopening. We're still seeing some of that, although we're starting to see mixed signals now with some factories closing on the other side. But we're still seeing job growth, unemployment numbers down. All of these indicate a strong economy. All of that was a big reason to see the rate spike. We had some other political things that kind of fell into the mix. We have these tariff and trade negotiations with China and several other countries. China is always on the top of the headlines, but we've implemented some major tariffs. Some of that started and took place in the middle of 2018. So there's a big ramp up to try to get the goods on the U.S. soil before those tariffs took hold. So that was kind of the big ramp up, and that started in June of last year. We had another round of that kind of, if you look at the trends, you'll see that spike again toward November of last year. And it didn't happen. And it pushed off until what was supposed to be March and then May. So actually just last week, we saw those additional tariffs take hold. It's played havoc on the freight market, especially the spot market, because the contracted freight is pretty consistent. It's the spot market that will try to take on these peaks and valleys. All of that has played an effect. All of that has really changed things. So about 2 weeks ago, we saw the tariffs really take hold. So now the market has to stabilize one way or the other. Are we going to see the economy, not the trucking market, because you have to take your eyes just off the trucking market itself? Are we going to see the economy start to slow down as a result of some of these political things happening? Are we going to see... Now, what goes up must go down. We are seeing economic indicators that we haven't seen in a long time as well. Just like we saw the spikes and the peaks in the freight market last year, we're seeing the same indicators in other segments now. Manufacturing is up. The job growth is up. Unemployment is down, which is another good thing. All of those are at record levels. Again, what goes up must come down. Will these tariffs and will these trade wars or whatever we're getting ourselves into, will that, and not just trade wars, but potentially other conflicts? We're dealing still with North Korea. We're still dealing with Iran. That plays a big role in it as well. We've got not just the trade on goods, but we also have the oil in the Middle East. All of these things that it's hard to focus on when you're just driving a truck. All you can think about sometimes is dealing with brokers and hauling the next load. It's a bigger picture than that. Right now, things are actually good. I talked to one of my drivers, leased to us here at Patriot Star. She went out about October last year, bought a brand new Volvo fancy 860 Globetrotter, beautiful truck. And it comes with a beautiful payment. And I was a little worried about how she would handle this. And I talked to her a couple of weeks ago and I said, what do you think of these rates? And she said, rates aren't that bad. Now, if you think about that, she got into this in October, the end of the season, the end of the spike, so to speak, the end of the records when they were on the downturn. She got into it when she didn't see those huge astronomical spikes. So for her perspective is it's not that bad. And it's really not that bad. I've been in this long enough to know that 2015, 2016, 2017 were worse than it is right now. Maybe not so much volume-wise, but rate-wise, it was harder then to get the rates that we're seeing now. I look at the majority of the trucks that we have, and they're still doing fairly well. I'm also seeing a lot of people that went out last year. We're on YouTube, so let's call these guys out. I won't call them out by name, but there were a lot of people that went out and bought the long hood W900s or the 389 Peterbilts and got the fancy brand new trailers and decked them out with the lights. Or there were people that went and got their Authority in the high season as we're coming into that late 2017, and that's what they knew. And first quarter of 2019, they closed up their Authority. They walked away from their trucks. They turned everything back in, and they threw their hands in the air, and they're going to get company jobs, or they're trying to salvage whatever they can. Why is that? If, as my driver says, it's not that bad. Well, to them, they built their business on those high rates. You can't afford those astronomical truck payments with the fancy chrome and all the stuff that you have to put into being a show truck and all those types of things. It's just the market won't bear it right now. Last year was great. Everybody that went out and bought those last year, they were loving life last year. Here's another thing that I think it's important to understand is you have to make hay when the sun shines. I want to talk about that here in a minute because I've got a few points I want to bring up. How do you survive this market that so many people are crying doom and gloom over? It is slower. It is harder. From the period of April 2018, which was the hard enforcement mandate of the ELD, until about October, there were about 4% more utilized trucks on the road. Utilized meaning more trucks, not just going off of how many trucks have license plates on them, pulling numbers from the DMV, not just how many drivers have driver's licenses, but how many loads are being moved, how many trucks are actually on the roads, about 4%. If we look in history, the last time we saw record rates prior to 2018 was 2014. And back then, the analysts were saying that the reason we saw those huge spikes was because we had about a 2% capacity crunch. In other words, about 2% of the market either fell out or there was about that much more capacity that we needed to keep the rates up. So about 2% is what caused the spike in rates in 2014 that was setting records back then. 2018, we saw those record rates in the beginning of the year, driven by a lot of the political factors and so forth that we had just talked about. Everybody saw those amazing rates, went out and bought a truck or got their Authority and what have you. Really started to take effect on us after the volume started to drop off a little bit, after the tariffs were already in effect and so forth. They said that between April and October last year, we put about 4% more up. So in 6 months, we increased our capacity 4%, and we're seeing the effects of that now. Now, in 2017, early 2017, throughout 2015, 16, 17, FMCSA got about 150 new applications for Authority every single day throughout 2015, 16, 17. Now, it seems like a lot, but this is nationwide. This is big companies, little companies, everything in between, 150 a day. And that's really, if you big picture with 350 million people in the country, 150 a day is not that many if you think about it. But As we got to the end of 2017 and through 2018, that number about doubled. We saw about 300 per day. Understandable, the rates justified that. The rates, everybody went out and got their authority. So what we saw happen in 2017 and 18, end of 2017, in that market was a lot of people were leased to these mega carriers or in industries that were completely outside of the trucking altogether. Maybe they held a CDL, they didn't like the rates they had previously, so they got back into the industry. They went and bought their truck for the first time. The mega carriers increased rates, increased bonuses. They did a lot of recruiting efforts, bring new drivers, fresh blood into the industry. Really inflated the industry. A lot of people that were leased to those mega carriers, and I've said it before, this industry is really not designed for, there's no good way to put it. The weakest link is really how this whole industry is built. You don't have to be a rocket scientist to get involved in the business. To run a good, successful business takes a little bit more thought involved. But last year, you could basically go buy a truck, and actually I know people that have done this, didn't even have a CDL, bought a truck. That week they bought the truck, took the road test, and were running under their own authority that first week, and they were killing it, making killer numbers. And they did that, no experience in trucking whatsoever. You could do that last year. This year, it's tough. If you don't have a little bit of experience and have a basic understanding of business and how you can run it and run it efficiently, you would really struggle. That being said, there are a lot of people now making a different shift. So where they were leased to those big carriers last year and going and get their own authority, becoming an owner-operator, maybe leasing to a small carrier where they had more negotiation power, more flexibility to work with different brokers and so forth. Now they're looking for new options. So if they were leased to a small carrier, maybe they're looking, they don't want to give away that percentage, whatever it is. There's a carrier out there it's paying 97.5% of the freight rate to the truck. But they think that that extra 2.5% would really put them over the top, so they go get their own authority. Or you have somebody that is leased to one of the big carriers that thinks, I can't make it here, I need to go out and maybe lease to a small carrier that's got more room. Again, the same thought process that they had when the rates were good, they're kind of justifying it backwards now to still make that happen. So what we're seeing is, when I saw 150 applications a day in 2017, spiked to 300 applications through 2018, guess how many we're at here at 2019 now that the rates have really tanked for everybody? We're still seeing 300 applications a day, give or take. We're still seeing double what we saw in 2017. We're still seeing more and more people go out there, get a truck, get their authority, and really get into this business. Some people got into this, or are still getting into this, thinking rates aren't that bad. It's a perspective change for a lot of people. If you were just getting into this business and you had the basic understanding and the basic numbers on paper, maybe rates aren't that bad. If you went through 2018 and you built yourself up to those numbers, rates are horrible right now. So how can we wind ourselves back and really focus on our business? Because now is the time to make business decisions. I posted, I guess there was a post in one of the Facebook groups basically about where you should run and when you should run there and so forth, and went back and forth, and somebody made a comment. I thought this was great. And I guess it was about getting direct customers and why people don't get direct customers. And I have my reasons why I think that is. But somebody said, I run a business. This is not some tourist show. You come out here to make money. When I hear somebody say, I won't run here, I won't run there, I won't do this, and I won't do that, that tells me I don't want to make money, I don't want to make money, I don't want to make money, and I'm not going to make money. If you're on the spot market especially. And I am watching, I know we had some technical glitches in the beginning there, so a lot of people joined us in the beginning may have fallen off because we didn't come on live, and I managed to get the exact same stream up live. It was a Facebook glitch, or YouTube glitch rather. I am watching the stream here, so if anybody has questions or comments, unfortunately, because of the delay, we lost our phone line, but I will be watching the comment section here on YouTube. So if you have any questions, comments, throw it out there, and we'll see if we can get it answered. So we're still seeing a lot of new authorities coming out right now. Applications for new authorities are still at record levels. Used truck prices are not dropping like you would expect. You would think that with the lower rates, you would see the used truck demand drop, and therefore the prices would drop. Trucks in the 3 to 4 year range are really holding pretty steady over what they've seen over the past year or so when the demand was extremely high. So we've got new truck demand high, new authority still high, still dumping more capacity into the market. How do you compete with that? How do you overcome that? There are still people that think that the surge we saw last year is still happening. How can you overcome that? Let me start with this. What doesn't kill you makes you stronger. What does not kill you makes you stronger. I said this a lot last year. Build relationships. I had some fleet owners telling me that relationships were worthless. A couple of those fleet owners actually are on their way out the door. A couple of those fleet owners have already closed it up this year because they thought relationships were worthless. Right now, I can tell you that the majority of what we're surviving on are the built relationships that we already have. If we call in a load board posting and so forth, or if you post your truck, as a broker right now, if you post a truck somewhere, to me, you're begging for freight. Please, please pick me. Please pick me. I need a load. You're begging for freight. A lot of people think that if the broker calls you, you are in control of the negotiation. I disagree with that. That's all a mindset thing. If you post your truck, you're begging for freight. If you call me for a load, you're begging for freight. If I call you for a load because your truck is already posted, I know that you don't have anything else to do. Your truck's posted. I'm calling you because you don't have anything else to do. You're desperate. You posted your truck because you're desperate, because your relationships didn't pay off. The lanes that you built last year didn't pay off. You posted your truck, so I know that you'll take whatever I offer you. And I laugh when I call a posted truck and they shoot some astronomically high number. I give them my rate and I let them call me back. Complete different from where we were last year, because I was giving the opposite advice. Post your truck. And it's still, don't get me wrong, it's still extremely important to post your truck. I don't want to mislead anybody with this, but it's a mindset thing in the negotiation. You have to understand it doesn't matter who calls who posts a load or who posts a truck and so forth. It's still a negotiation. Don't be fooled into thinking that just because you posted a truck and they called you, that you're in any better situation. So as a broker or as a carrier, I tell people, when you're negotiating, throw out your number, let them call you back if they can't find another truck. It's difficult in this market. It's a broker's market right now. It's the shippers. They're the ones in control of the freight right now. So as a broker, I do the same thing. I'll throw out my number and I'll let the carrier call me back. More often than not, they call me back, and I do the same thing I do if I'm a carrier. I give them a better number in my favor. In this case, as a broker, I would give them a lower number. They called me back. They're desperate. They had their truck posted. It's been posted all day. I called them. They threw out some astronomically high number. I throw them my number. Sometimes it's even a Japanese no that I've talked about in my negotiation trainings. Let them call me back. Relationships will pull you through this. Unfortunately, in many ways, you missed the boat on building relationships. The time to build relationships was last year. Does that mean you cannot build relationships now? Of course not. Get out there and build them. Get out there and try. Do everything you can. But everybody that didn't take that seriously last year are the ones that I see folding up right now, the ones that I see struggling most right now. So relationships is a big word that I use a lot. I use it in a strong market. I use it in a weak market. I use it all the time. Relationships, relationships, relationships. I won't use it again tonight. So the other thing that we talk about a lot, know your numbers. I talk about that a lot, all the time. Super important when you're negotiating, right? You have to know how to negotiate with numbers. You have to know where you're at with your numbers. When you're negotiating, you have to know what you need to make, right? You need to know what your bottom line is. You need to know where you stand in the market. You need to know your walkaway number, your aspiration, your dream number. You need to know your range, your ZOPA, zone of possible agreement. If the broker comes in here, you come in here, you've got that range. That's your zone of possible agreement. You need to be firm on that. Our highest grossing truck in the Patriot Star fleet last year has a little card on his visor, flips down, and he knows exactly what he needs every time, and he's firm and confident about it. He's friendly, makes conversation, but he's firm and confident about his numbers. As a broker, when I'm making calls, when somebody is hemming and hawing or just throwing out random numbers, I know I win every single time. Every single time. They have no idea, and I can, because I know my numbers. I know what the market's doing. I know where they're at. I know where the load's going. I know all of that. And when I start throwing out the numbers where they should be, and I will, in my negotiation style, when I'm dealing with carriers, I'm just like this. I start schooling them. I start schooling them on why their rates are wrong. Sometimes I school them to the point that I feel bad for them and I give them more than they're asking for because I just feel that bad. But I will tell them, I will set the numbers for them. I will explain to them how to set the numbers. Unfortunately, most drivers don't know their numbers. And I see it from both sides as a broker. We've been moving a lot of stuff. The spring season is the peak season for our brokerage because we do a lot of show freight and so forth, and all the shows are starting to kick off right now. So there's stuff moving all over the country, and we're moving stuff, and we're in a broker's market. So it's crazy to hear some of the things that these carriers are saying. Columbia Glider Dave says you must have had to rewrite that card. Which card are you talking about, Dave? Because I think I know what you're saying, but I want to elaborate on that a little more. And I'm reading all the comments here as well. Next week, I'll try to have the phone lines open as well. So it's important to know what you need to make in this market for negotiation purposes primarily. But what's even more important in this market is to know what you have available. Know where you stand. Know what you have in the bank. Know your cash reserves. Know your assets. Know what your accounts receivable are. Know where you stand and understand your cash flow. Right now, cash flow will put you under. I'm not telling anybody to go out and go factor your money. That's not what this is about. Right now would be the worst time to go factor your money, as a matter of fact. Do not go out and do that. But be very, very careful and stay cognizant of exactly what you have for cash flow. Know your numbers inside and out, and make sure, what's important right now is to make sure that you are still in the black, meaning the positive. You don't want to go red. Everybody knows what Black Friday is. That's the day that the stores go in the black. They run in the red all year. Black Friday, they go in the black. You want to make sure that you came out of 2018 in the black and you stay there. The next thing is cut your expenses. How do you stay in the black? You control your costs. A lot of people went out and splurged last year, bought all kinds of new stuff. I was going back and I was trying to find some of my shows. Almost every show I did in the spring last year, every single one, I said, be careful what you spend. Don't go buy a new Harley. Don't go buy a new boat. Don't go buy all your new toys. Don't do it. I told everybody last year when we were in peak season, do not do it. People did it anyway. You need to look closely at what your expenses are, and you need to start cutting those back. If you are able to renegotiate interest rates, if you are able to get rid of some of the toys that you have these excess payments on, do it. It's time. You have to stay black right now. You have to stay liquid. If you go red right now, it'll be very, very difficult to recover. I have on my note card here, make the hard decisions. We talk a lot about doing the hard work. Right now, the hard work is making the hard decisions. You need to cut your expenses. It's hard to get rid of the toys that you've grown accustomed to. It's hard to, maybe you've got drivers that aren't performing. Maybe you have excess office staff. Maybe you have apps and software and so forth that you've been paying for, subscription services, multiple load boards. Maybe it's time to cut that back. It's difficult to make those decisions, but now is the time to make the hard decisions. Control your cash flow. We talked about that. Something that we don't talk about often on this show is a cash flow report. We talk a lot about balance sheets. We talk a lot about profit and loss statements. Those are important. Those are what your tax returns, are based on at the end of the year. You need to make sure that you've got money in the bank, and you've got to make sure you're profitable, and that shows you that. But if you use a cash flow report, you can start to project your future earnings. And you can do that by, again, looking at all your accounts receivable. Look at not just your expenses in and out, but future expenses and future income that hasn't materialized yet from other investments, from, I've got some stuff here, some financing options. We mentioned factoring a minute ago. Now's a good time to go talk to your factoring company, renegotiate those rates. Some of them already know you're over a barrel. And if they know you're over a barrel, they might not renegotiate with you. A factoring company's job is to put you out of business, whether you like it or not. I hope that if you are on the verge of going in the red, that you have an exit strategy from your factoring company if you're using one. There are a couple of factoring companies over the past year or so that will not let you edit their contracts, like I talk about a lot, and they have foreclosed on the owner's houses. Being incorporated doesn't help. Having multiple companies and these layers of protection don't help. When you sign those contracts with these factoring companies, they will hold you personally responsible. And the way that the market is right now, we're going to start seeing brokers that aren't going to be able to make their payments. We're going to start seeing shippers that are stretching, especially if we start to see the economy start to come down as well. If this is a ripple effect and we start seeing it in the other areas of the industry. If you start to see your accounts receivable get further and further days to pay, further and further stretched out, or you start to see brokers with their credit scores wavering, be very, very careful with that. If you have a claim or you have a broker that doesn't pay you, I don't care if you are in a non-recourse contract or not, you better have made sure that contract was solid in your favor. Now's the time to go back and read those fine prints and maybe renegotiate with your factoring company. And I see Jason and Chris are two of my drivers in the... Jason, Chris, and Mike was a former driver of mine. I have some very interesting comments, and I'm going to come back and talk about that. Control your cash flow. Watch your future predictions. Make sure you're accurate. Don't go out and assume that you're going to land some high dollar freight. Don't assume the market's going to turn around. Prepare for the worst. That's always good advice. Prepare for the worst. Expect the worst. Prepare for the worst. Hope for the best. Keep an eye on your profit and loss sheet. Keep an eye on your balance sheet. And keep a real close eye on your cash flow reports. Talked about building relationships. If you have not built the relationships and you don't have that in your back pocket already, of course, now is the time to really make sure that you focus on that, which means you need to improve your customer service. There's a lot of ways to do it, and there's a lot of ways that I could talk about, but I don't honestly want to give away my trade secrets right now. Jason and Chris and Mike all know what some of the things that we do, but if you're not doing something to set yourself apart from the other carriers, even if you're a one-truck operation, or even if you're leased to a carrier that's not doing anything for you, if you're not doing it yourself, you better look hard. You better figure it out. Customer service is how you build relationships. Customer service is what keeps you surviving in these times. We are in a commodity market. The trucking industry, anybody can go buy a truck. I mentioned I have some people that I worked with last year that went out, bought a truck, didn't go to school, didn't hire on with a mega fleet, didn't go to some other company. They bought a truck, jumped in it, literally took the road test in the truck that they bought. Within a week, were up and running, got their authority going, completely 100% on their own, never did any of that stuff. Customer service is key. It's super important. That will set you apart. Number 5, improve your customer base. Everybody right now thinks that they can go be a broker. We started our brokerage a couple of years ago. We've been making literally hundreds of phone calls. Last year I had 2 full-time, I guess you'd call them salespeople. They weren't the best salespeople maybe, but they were definitely doing their best. They were out there making calls. 50 to 80 calls per day each was the goal. 50 to 80 calls per day each. They kept that up for almost 6 months solid. We got some decent relationships out of it. We landed some customer stuff out of it. But if you are a one-truck operation and you think you're going to go out and just knock on a couple of doors and they're just going to bend over backwards for you, try again. Getting customers and becoming a broker is not the easiest thing in the world. I can tell you that right now. We did it because we already had customers that we needed to service. We needed the extra capacity. Right now, there are so many broker schools and all these training courses and all this stuff going on. They're not teaching you anything. I promise you, I don't care how much you pay for them. They're not teaching you anything on how to actually get the customer. You're going to have to supply customer service. You're going to have to talk to people. You're going to have to get out there and prove yourself. Improve your customer base by finding the right relationships to really, really focus on. Make the most of what you already have. Lean heavily on your trusted relationships. And if you've built the right relationships, they'll respect you for that. You could even be honest with them and say, look, you are my go-to person right now. Obviously, you all have had brokers do that to you last year. You're my go-to truck. I need your help. Well, you can do that to them now. If you built the relationship. If you didn't build a relationship and you come with that tone, they're going to laugh at you and hang up. Before I do these shows, I always try to do a little prep. I have my talking points that I want to address, but I do a little bit of note-taking and, read some other articles and so forth. I came across a lot of articles about small business, about how you survive in the weak times, and a lot of them said you should diversify. There's merit to that. You should diversify. but you need to diversify carefully. So be careful that diversification doesn't dilute your primary service. In other words, if you own a flatbed, a Conestoga, and you run a certain lane, diversification probably doesn't mean go out and buy a reefer and try to do something completely different and work with completely different people, because now you are servicing two completely different markets. The trusted relationships that you built won't do anything for you. You might say, well, reefer rates are good here and van rates are good there and flatbed rates are good here, so I'm going to go out and diversify, maybe get different trailers, different types of equipment. I'm going to supply different services. Be very, very careful with that. If you're going to diversifying things that will show a return without affecting your primary services, your primary business. So maybe now is a good time to focus on completely separate businesses. But be careful, again, not to let a completely separate business drain your primary business. All of my businesses are intertwined. They are completely separate businesses. My brokerage, my carrier, You Drive You, the training company, they're all carefully intertwined, and they help each other grow. They're diversified, but they provide one service, one central service. So be careful you do it the right way. And don't spread yourself too thin. That's the last note I have on a diversification. Don't spread yourself too thin, and that's really what it comes down to. One of the reasons that I haven't been doing this show this past 6 months is because I've been spread pretty thin. Last year it was easy. The market was cooperating. It wasn't a lot of headaches in the office. This year hasn't been that way. A lot of this is falling back on us here in the office. A lot of the struggles that we put up with. We've had more claims, more losses, driver issues. We've had a lot of things have come back to us here in the office during these times. And I had to streamline what I was doing. I had to focus on the primary business. I love helping you all. I love giving all the support I can to everybody out here. But my business and the contractors that rely on us have to come first. And I had to make that hard decision. I couldn't do this show consistently and give it the quality that the show needs because my business would have suffered. So it's super important about that. I'm going to go back and talk about these comments here, and I'm going to have to somewhat be careful. These are some of my drivers and one of my former drivers kind of going back and forth, and I want to address some of the points they're making. But I'm careful. If you've noticed, I never share my numbers because my numbers are a direct reflection of my company and the owner-operators that are leased to me. So I'm very careful about not directly sharing that. I'll share a few vague things. Another point that I have here on the sheet is, and I already touched on it, make hay when the sun shines, meaning when the work is there, you have to do it. If you don't, when it starts raining, you're going to be crying. You're not going to have what it takes to survive. So something that I've noticed, a trend that I've noticed, the past several years with the contractors that I've had, contractors that have been with me for several years. And I look at their numbers at year end from 2014, 2015, 2016, 2017, 2018. Now, we know that the market has done a lot of this stuff. It's up and down craziness with the rates. One year you've got super high rates, one year they're down, one year they're up, one year they're down. What's interesting is some trucks are absolutely consistent. And you know what changes most? When rates are up, they go home more often. When rates are down, they have to work. It seems a little backwards to me. I want to work when I'm making money. I'll go home when it's not. 1099s, the year-end statements that I have to send out to drivers, year over year over year, have been fairly consistent with most drivers, no matter what the rates did. So if rates are up 30 to 40% like they were in 2014 or 2018 rather, you would expect that drivers' settlements and 1099s and so forth year-end numbers would be up 30 to 40% over the previous years. By and large, they were not. They were pretty much consistent. Again, home time was one of the things that fluctuated most. So here we are in the lean times again, and the most important thing is equipment utilization. So while a lot of people got really, really accustomed to those fantastic rates that they saw last year, where you have to be careful is if you also got really, really accustomed to all the home time you had last year. Unfortunately, especially if you don't have the cash that we were talking about and you didn't develop that cash flow that you needed to survive in the lean times, you're going to have to work, even if you don't necessarily want to. All right, let me get into some of these comments. We started late, so I don't want to go too far over time, and we'll make it up next week. Dave okay, so I mentioned one of my drivers has the card on his visor, and Dave says he must have had to rewrite that card for the rates because of the lower rates this year. Another, and I'm going to address that because I know there's some other comments further down that they were going back and forth on that. Is $2 a mile plus $1 mile realistic, right lane? I don't really know what you mean by that. Is $2 a mile plus $1 a mile realistic? It depends on the type of trailer you're pulling. Certainly $2 a mile is realistic in this market. Definitely with a reefer or a flatbed. It'd be hard with a van, but we've got a couple of drivers that are pulling that off. Chris, which is one of my drivers, says, I'm on a $5 a mile, 699 mile load right now. Did $10 a mile load Monday, 2,500 on 250 miles. Chris has a step deck Conestoga, ultra low profile step deck Conestoga, which is very rare. He's able to find some unique stuff. And he is one of our top earner trucks. All right, so Dave was talking about changing the rate card, and that driver replied, my rate card has nothing to do with the market. My rate is based off operating cost and desired profits. Trade secret, Jason, right? What is your cost and what is it that shouldn't change? And they're still going back and forth on that, so I'll come back to that. So Mike says, if you can lock up a direct customer, but you have to buy equipment, do you proceed? That is a tough question. Certainly, I would not go out and buy equipment right now over one customer unless that customer has some type of guarantees that that equipment is going to be useful to you in the future. So if you can lock in some contracts, or if you're buying equipment that can be used for other things. So in other words, when I lived in Michigan, there was a special trailer that you had to have for this certain piece of equipment that we did underground work with. If you were going to get a customer right now and they had one of those machines and you needed that trailer, I would absolutely not go buy that particular type of trailer, because that's the only thing that you're going to use it for. And if that company goes under for some reason, you just spent all the money and the trailer's useless. You're out of pocket. So there's a lot of consideration that needs to go into that. Number one, is that equipment useful for other things? Number two, is that equipment going to guarantee you some type of revenue stream and cash flow? Will it lock you into a contract? Even then, you have to be careful. We all know about Falcon Transport, Falcon Trucking Transport. They went under because one customer ultimately closed up, GM Lordstown in Ohio. They closed up. That was their biggest contract. Now, they had pretty standard trucks and trailers, but they lost one customer. All that stuff is financed. You've got the payments. Remember, keep your costs under control, your expenses low. If you have to go out for one customer and spend a bunch of money to lock that in, you really have to decide which way to go. So Right Lane says, my cost $1.60 mile to break even, pays household expenses, fuel, truck payment, insurance, and maintenance fund. And Dave says, Right Lane sounds about right. Okay, so, and there's throwing around some numbers. I'll address some of the numbers that everybody's throwing around. So Jason says that his card, his walk-away number card doesn't change with the market, and that's absolutely true. What you want, what you dream to get, obviously is going to have to change in this market. Obviously, you're not going to be able to get a home run every time in this market. But if you've put your walk-away number card together, whatever your formula is, that cannot change. That is your cost. That is your number. That's what you have to hit. Now, Jason has that card in his visor. The way Jason does his numbers works for him. And somebody that's established the way he is, that's fine. But I don't necessarily agree with the way that Jason does it. And here's why. Jason takes all of his household expenses, and I would not advise doing it this way. It works for him because I would say that he is relatively set. He's not going out and changing a lot in his operation, changing around in his lifestyle and his home. He's got a pretty well fixed set of numbers. If you're new, if you're just getting started, be very, very careful doing this. A lot of people do it. I don't advise it. Here's what they do, and I would not advise doing this. Take all your household expenses, all your business expenses, everything, put it in one pot, and figure out what your costs need to be to pay all of that. If you are established enough and that is a very consistent number, and it's a reasonable, attainable number, that's a fair way to do it. I don't advise doing it that way, and here's why. If you live in Mar-a-Lago, you have $1 million mansion somewhere, and if you have a Mercedes and a Bentley and so forth in your driveway, you're probably not going to make it in this business. I mentioned getting rid of the toys. You can take all that stuff, lump it together, figure out what your costs are going to be. But if it's not a reasonable number, you will fail. Now, Jason's got his reasonable lifestyle set up, and he's got it in order. But a lot of people last year, and this is why a lot of people are failing right now, went out and bought a new truck, went out and bought a lot of new toys, went out and built a lifestyle based on the numbers from last year. Didn't pay any attention to what they were paying themselves. So how can you avoid that? Especially if you're new, especially if you're still trying to develop your business, how can you avoid the pitfalls of the expenses that are out of control? And here's the way that I would recommend that people do this. When I do my presentation on how to quote a load, I go around the room, and you can go back. I've done it on some of my previous shows. Go around the room, and I get numbers from people. And I always have multiple extremes. Somebody on one side of the room will say, I can do it for 60 cents a mile. Somebody on the other side of the room will say, I need $5 a mile. I always pick on those because they're the easy targets, of course. So the first thing I do is pick the guy that says he needs $5 a mile. Why do you need $5 per mile? Well, because I won't turn my key for less than whatever. Principle-based decisions. Ultimately has no idea why that he needs $5 a mile. He wants $5 a mile. He's established principles to set in stone, and he won't turn his key for less than X amount per mile, whatever the number is, $5, whatever, 3, 4. I won't do it for less than that. I have to get that. If I'm not hauling stuff for free, I'm not going to. It's a principle-based decision, which is very harmful. It's not good negotiation. It's a bad position to be in. You have to be careful with that. So I always pick on that person first to make that point. They usually throw out something like, well, that's what I did last year, or that's what DAT says I should do, or that's what this or that. And they always have some way to justify it, but ultimately has nothing to do with their business. What the average rates are has nothing to do with what your costs are. What the average rates are, what you saw somebody do last week, or you heard at the lunch counter at the truck stop, has nothing to do with what you need to make. So let's just throw that out right now. What do you need to make? My question was that. What do you need to make? You need to have that number. So then I picked this other side. The other side is 50 or 60 or 70 cents a mile, the low end. And I asked, how can you do it that cheap? Well, fuel is 50 cents a mile. My maintenance cost is 10 or 15 cents a mile, and that's my only expense. My first question, once they explain how their costs are so low, my first question is, well, what do you pay your driver? And the first thing they say, I don't have a driver. I drive it myself. So in other words, what you're saying is you're willing to work for free. You are willing to work for free. No, I didn't say that. Well, you just said that you're willing to drive for 60 or 70 cents a mile. That's your cost, right? No, that's not. I have to make a certain amount. Well, then that is a cost. It's funny, I've had fleets that have leased to me. When that one driver is driving that one truck, they will do things like deadhead out of Florida. The minute they put a driver in that truck, all of a sudden it's extremely important to keep the deadhead low and make sure they get something out of Florida. It was very interesting to see the entire change of mindset, just because now they have to pay a driver. But don't you have to pay a driver even if you're driving it yourself? So going back to lumping all of your household expenses in with your business expenses, those are two very separate things. So when I talk to that 50 or 70 cent per mile cost driver, and I say, well, if you were to hire a driver, what would you be able to hire that driver for? And inevitably, they always, because they're focused now on keeping their costs low. So they always say, well, I could probably find somebody to do it for 30 cents a mile, 35 cents, 36, 38, whatever their number is. So what you're telling me is you can hire a driver to drive your truck for 35 cents a mile. Yep, I think so. So what you just told me is you, the owner-operator in that truck, you are worth 35 cents per mile. All of a sudden, I see the wheels start spinning. No, that's not what I said. That's not what I said. Well, wait, you just said that you could be replaced for 35 cents a mile. So what does your customer think? What does your customer think of you? If you could be replaced for 35 cents a mile or whatever it is, 40 cents a mile, that's all you are worth. That is the value that you provide. That's the value you bring. But I own the business. Okay, I get that. So how much do you as a business owner make? You need to make X amount. So if you hired a driver, the driver's out driving the truck, and you're going to make X amount above that. Now, right now, I think it's reasonable to shoot for in the range for a driver pay around 50 cents a mile, maybe more, but 50 cents a mile is reasonable. You see it on the back doors of these mega fleets, and you see, it's out there, 50 cents per mile. So let's just use that as a round number. So 50 cents a mile, maybe some of them are paying 60 or 70 cents a mile. And I have you know that some of those that are paying 60, 70 cents a mile are already closing up shop. They're already laying off drivers already. They're already selling trucks. They're already getting rid of that because they put a lot of emphasis into really trying to pad their pockets last year. And this year, those drivers are going elsewhere. So 50 to 60 cents a mile that's what you can make as a driver. If that's what you can make as a driver, what about your competition? So you've got the fleets out there, the Swifts and JB Hunts and Primes. What are they making per mile? Now, just because you own the truck doesn't mean that you can just demand 3 times more than the average driver is going to make. Remember, the value that you bring is what you could hire somebody else to do the job for you. Now, you own the business. How much more do you make on top of that? So, going back to my example, lumping all your household expenses in. Unless your household expenses are under control, lumping that into your trucking costs and expenses is very, very dangerous unless you have a full understanding of where you're at with that. If you can't survive on the money that you could make as a company driver, driving your own truck, if you hired yourself to drive your truck, that money that you make, could you survive on that? That's really how I like to break it down. So you have an understanding of how much money you actually get to make. If you make more, that should go in the bank, of course, and that's your company profits. But again, I don't know that you can survive at 50 cents a mile if you have a couple of mansions in Malibu and you've got, your Bentley. You could go ahead and lump all that in there and be the guy on the other side of the room. I need $5 a mile. Why? Because I have a Bentley. Yeah, but your competition doesn't have a Bentley. So you'll be out of business quick, and that Bentley will be on the auction block. So just keep that in mind. I advise people, and it works. Jason's way works for him, and he's been doing it that way a long time. I don't, and he knows I don't advise doing it that way. Keep your personal expenses and your business expenses separate. Keep your personal expenses within reason so that you can afford to pay your personal expenses off of what a reasonable wage for a truck driver would be. Above what a reasonable wage would be, that is your company profits. Put that in the bank. Keep that for times like now when it's not as easy to make the money. Okay. All right, let me just read these out loud so you all don't stare at me. What would you say to the head of trucking at Tyson to get a contract with Tyson? That's an interesting one. What would you say to the head of trucking at Tyson to get a contract with Tyson? Hey, Mr. Tyson, I've got a truck. When you're dealing with those mega companies, those huge companies, you don't get to say much of anything at all. What you get to say is, hey, can I get on your list? Can I put in a request? Can I put in a proposal or a quote? And typically those big companies, and I'm not sure of Tyson's process, but typically most of the cold food storage places that I know of all put out quarterly, biannual RFPs, requests for proposal, or RFQs, requests for quote. And you bid on lanes, and ultimately it's race to the bottom type rates. So you don't get to really sell yourself in a lot of those types of places, other than you can start to build a relationship, and you can make sure that you are one of the first to get a chance to be on that list. There are definitely people that don't get the opportunity to bid. So you do need to build that relationship. You need to get your foot in the door to have the opportunity to bid. But your bids have to be reasonable. They have to be justifiable. You can't just walk in and say, well, you're a direct customer, and I saw in DAT that direct freight on this lane is paying this much a mile, so that's my bid, because everybody's doing that. You have to figure out how to make it work for you and to win that bid. Ultimately, it is, I use the term race to the bottom, but it's really not a race to the bottom. It is a race to the finish line at this point. Some people aren't going to finish. Like a NASCAR race, crash and burn, DNF, did not finish. A lot of people aren't going to make it. Your job right now is to put in a quote, a proposal that they will accept, where you can be profitable, do all these things on my checklist, mind your expenses, watch your cash flow, improve your customer service so you're on that list, know your numbers, make sure that don't go in and undercut yourself, don't underbid yourself. If you don't know your numbers and you put in an RFQ, I almost guarantee that you're either going to lose bad, crash and burn bad, or you're going to win bad. Win bad meaning they're going to give you that contract and you're going to lose money every time you take a load, and you're going to kick yourself for it. And every carrier that you come across along the way is going to kick you for it too, because you took it out from under their throat. And you're just harming everything. There are a lot of carriers. I would say, one of the biggest problems that we have in the industry right now are some of the either inexperienced or mega carriers, two extremes there, either the really inexperienced small carriers that don't know what they're doing, or the mega carriers that absolutely know what they're doing. They've got bean counters that can get it down to the fraction of a penny and can either quote it super low because their costs are so well controlled, or the inexperienced ones that quote it super low because they have no clue and they go out of business in the first few months. That's where the spot market tends to come in and pick it up. That carrier can't make it because they screwed up their quote. Now the megas, this big shipper has to put it on the spot market to try to save it. And Mike was asking about buying the equipment, and he said that the equipment he would have to buy is dry vans. Dry vans are most versatile. They are the biggest commodity, but you can always keep a dry van moving. You might not always get a dry van moving for the rates that you want, but you can always keep a dry van moving. I would not necessarily be opposed to buying dry vans if that's going to lock you into a customer. I could keep a dry van busy and profitable, minding your expenses, keeping all that really close. So I would not be opposed to buying dry vans right now. I wouldn't be opposed to buying anything if it fit the right need, but you got to make sure the need is correct. Right Lane says, when I get my new entry safety audit, will they ask for driver logs? If so, how many weeks or months? Yes, they will. Typically, they're going to go back 6 months. And of that 6 months, typically they're going to ask you or roll the dice. They're going to say, 6 months, what was your busiest month? And you'll pick one. They'll say, that's the month I want to see. Give me all of your logs. They're going to ask for your logs, and with that, they want your fuel receipts. So if you use a fuel card, you're going to have to give them a printout. So the fuel card, the time on your logs has to match whatever's on either your credit card receipt, or if they happen to print times on the fuel receipts. If you notice, most truck stops don't do this for that reason, because they don't want to be hung up on that liability. Fuel receipts, toll receipts is another one. If you use a Easy Pass transponder, or if you go across a lot of tolls, they will look to see what routes you are on. And if it was a toll route, they will want to see the receipts for that. That has to match your logs. If you're going through a toll booth at a certain time, toll receipts and so forth are absolutely time-stamped, and it better match your logs. They're going to want to see the bill of ladings and all the accompanying paperwork. So if you have scale tickets, if you have a bill of lading. So if you go to a shipper receiver and you're demanding detention and they write the in and out times on that bill of lading, that better match your logs. All of that, and they'll ask for 1 month's worth. They will ask for at least 1 month's worth. If they find any issues, they might ask for more. They can ask for the entire 6-month period of logs, but they will ask for at least 1 month's worth. They blamed it on a bad contract with Amazon eating up their capacity. Oh, Falcon. Yeah, I heard a couple of stories. They're blaming Amazon. They're also blaming the contract with GM, putting them under. There was a representative in Washington from Ohio that literally went on a raging. It was kind of ridiculous. Right there in the house, just screaming about how horrible things were because they lost that factory. And he brought up Falcon specifically, talking about how they're losing jobs in the state of Ohio, and 600 drivers from Falcon were put out of work. But the point is, don't stretch yourself too thin. So have too much equipment financed. I absolutely know there's been several. I could bring up some companies by name, but it's better I don't. There's been a lot of companies, big and small, 50 to 100 trucks. One bad, and this goes back to the factoring that we talked about before. You have a claim, and the factoring companies will hold everything. If you have a claim, factoring companies could potentially hold everything. Mention, they might come after the owner's house. So it's extremely risky to do that. But if you have all of your cash flow tied up in something like that, and you have a bunch of equipment financed, this is one of the reasons I try to own more equipment than I have leased. I can't own it all because you have, turnover and drivers coming and going, and you have to do certain things. So you have to have some equipment. You have to have the flexibility of having some equipment leased or on loan. But I try to own at least half or more of everything we have out there. That gives you some flexibility for cash flow. When things get tough and the expenses start to exceed the income, it gets dangerous. So don't stretch yourself too thin with leasing equipment like Falcon may have done. Carrie says, I've only been doing emergency loads this year. I've only driven 9,000 miles this year. I want to work more, but not in this market. And Carrie's in a situation where he's not desperate, which is a problem that, again, knowing your numbers and watching your cash flow, if people would have been doing that last year and making hay when the sun shines last year, we had a driver that grossed over $400,000 last year, and he put his numbers out, so I'm not afraid to say that. We had other drivers pulling the same equipment that had the same opportunities that grossed less than half of that, and their excuse was, I just don't want to work that hard. And that's all I'll say about that. So Mike Spencer, any advice for getting insurance for a new authority? Been quoted $20,000 to $23,000 for one paid for truck and trailer. New authority, that's right in line with what you're going to see. Certainly the state you're in is going to play a big factor in that. The type of equipment you're in, even though it's paid for, you're probably getting some type of physical damage on it. My advice would be, if you are getting physical damage, do not overquote it. They're going to charge you a percentage of the value. So if you say, if you have a $15,000 beater, 20-year-old Freightliner Century, don't insure it for $100,000, because if you total it, you're going to get $15,000, but you're going to pay your insurance premium on $100. So if it's worth $20, don't insure it for $22. If it's worth $50, don't insure it for $60. So that would be my first one. You can keep your expenses low. Get the coverage you need. Don't get coverage you don't need. For equipment, for actual value, you do want to insure liability as much as possible. So in your first couple years, I'd recommend stay to the minimums, 100,000 cargo, and probably $1 million. You might get away with 750,000 in auto liability, but more than likely you'll need $1 million in your auto liability. Shop it out. If you have multiple residences, so for example, if you live, I use mine as an example. My company started in South Florida, down near Punta Gorda. That is an extremely high risk area. I moved up to the north side of Orlando, a little better area, I guess, and my insurance rates for the year dropped significantly. I moved to, I guess it was Orange County or Seminole County. I got an office about 3 miles away from my house, only 3 miles away. I moved my physical address to my business. I was working off the kitchen table. When I moved it to an office just 3 miles away, because I crossed a county line, the insurance dropped more. It was 3 miles different. So if you have something like that, use that to your benefit. Shop it out, figure out where the best place would be. Otherwise, 20 to 23,000 right now is not, for a new authority, is not out of the ballpark. That's actually right in line with what we're seeing. Chris says, I do the same thing with my spreadsheet. I just don't have the fancy card. Chris has a pretty well laid out spreadsheet to put in his numbers. Mike says, as do I, $2. Now, Mike, I know what you're shooting for there. I'm going to use you as an example, though. So when somebody just throws out a flat rate per mile, as a broker, when they just throw out a number randomly, I just need $2 a mile. Matter of fact, I wish I have call recordings of some of the carriers that call into me. I know most of you watching right now are, I think almost all of you are carriers. It might be a broker or two in here, but almost all are carriers. And carriers don't like it when brokers bash carriers. And there's a lot of carriers that do bash brokers the other way around, though. So I'm a carrier and a broker, and I can tell you this. I am set up with thousands, because almost every day we set up with a different broker. I'm set up with thousands of brokers, thousands. And they all have different ways of doing things. They all have different contracts. They all have different nuances and ways they negotiate and so forth. I'm set up with a few dozen carriers. I call a lot of carriers. I talk to a lot of carriers. It is a night and day difference talking to a carrier versus talking to a broker. Carriers have a lot of work to do. I would imagine that most of the carriers, and I know a lot of you watching, at least in the comments here. Let me add a couple of things here. Pardon me while I just make a couple adjustments here. All right, so Mike, as do I with $2. When the carriers just throw out random numbers, it makes me feel like they don't know what they're talking about. $2 a mile is, I understand he wants to get that. That's his minimum. What's that based on? To me, that's kind of based on, like I was saying, $5 a mile. Because why? Because it's a principle. I just want $2 a mile, or do you have a reason behind that? It's an easy number to shoot for, a round number. But when we were talking about the bidding on the Tyson Foods, if you just throw out a flat $2 a mile, you'll probably lose the bid. Or you might win the bid and then be really sorry that you did. So there should be a little more to it. I know, again, the mega carriers have their cost down literally to the fraction of a penny. But they have bean counters that their job is just to run the numbers all the time. So it's extremely important to really have a solid handle on your numbers. Do you need $2 a mile? Do you need $1.60? Do you need $2.50? Just a flat $2 a mile is an easy number to throw out there. And, of course, you have to adjust that with the market. Going into Florida, you have to make more than you know you're not going to make it coming back out. All right. And he needs $1,300 a day plus fuel, and he's pulling a flatbed, and he's talking about buying vans, which makes, you have to have a target, obviously. It's got to be a reasonable target. It's $1,300 a day reasonable? It could be with a flatbed in his area. But different lengths of haul, time, distance, all of that plays a factor. I've got a whole show I did in the past about how to quote a load. So go back and check that one out. Does anybody know about intermodal rates? I don't want to get too far off topic with that. Intermodal rates, similar to the way the big shippers work things. A lot of it is RFQs. You have to bid lanes. Is the new Sonar platform working for you? I'm going to come back to that, Chris, from Truck Driver Survival. Chris Martinez. Right lane makes my $11,000 for insurance seem like a gift. If you are established, if you can do 11 to 12 right now, that's reasonable. There are some new entrants. If you get a subpar insurance company, you might be able to get your rates down, but be very, very careful. Read lower. I got you, Mike. Makes sense. A lot of drivers make $2.40 a mile plus. Then these mega companies $1 a mile. It's nuts. All right, a couple points I want to talk about, and then we'll wrap things up. We're almost at 9 o'clock here, so I'll wrap things up. Do vehicle inspection reports need to be done on paper, or will using the ELD DVIR be adequate? Using the ELD DVIR will be adequate. Let me talk quickly about that as far as it pertains to compliance. If you find something wrong on your vehicle, it needs to go on that DVIR, even if you fix it. Most importantly, if you get pulled over and you get a ticket for something, so you have a light out, you have a brake chamber that's messed up, you have whatever, tires are bad, they're going to write you up for that. They're going to give you the driver vehicle inspection report from the state, level 1, 2, or 3. They'll mark it on the form. The carrier, you now as the carrier, have to sign that form to say that's been addressed. If you get inspected, and if this happens before your annual or before your safety inspection, they're going to want to see that. They're also going to want to see the DVIR for that day, and it better match. Because, yeah, they put you out of service. You had to have somebody come out and change that tire or fix that brake, and now it's fixed. So you, in your mind, you think, I don't have to put that on my daily vehicle inspection report when I do my post-trip because it's fixed. It's no longer broken. But it was broken, and you did notice it throughout that day. That form is supposed to be signed off by you that you did the inspection, that you found those things wrong. You need to accompany that. Your safety auditor will want to see this. You want to show the receipts that you had it repaired. And then the next day, you're supposed to sign off to verify that you did your pre-trip and that you are... you agree that the vehicle is satisfactory and safe to drive. So you're supposed to certify that, yes, you verified the next day. And the reason is, I understand that you are the one and only driver for your truck. But what if you were not? The rules are written so that everybody has to do the same thing the same way. If you turn your truck in at the end of the day, and think about this. You have your tire changed at a weigh station because the tread depth was too low. They put you out of service. You have somebody come out. They change that tire. You drive it onto the yard. The next day, somebody comes in, jumps in the truck, does a quick walk around, jumps in the truck, everything's good, and they take off. 5 miles down the road, that whole wheel assembly goes tumbling off into the ditch, kills somebody. Who do you think they're going to come after? Of course, they're going to go after the driver because they didn't do a proper pre-trip, right? But they're also going to come after you because you didn't write down that you had work done on that particular wheel end, and now, because the next driver was not aware that there was an issue that needed to be addressed, he didn't check that the way he should have, and it's your fault. Now, even though you are the same driver day after day because it's your truck, your company, the same logic applies. They want to see that DVIR every single day. If you have a repair facility come out, especially if technically for every repair that you have done, they want to see the receipts. I make an argument for that because I have all owner-operators, and they're running their own independent businesses. But if you're put out of service, you should have a receipt to back that up. So be very careful with that. Yes, you can use it in an electronic form. That's perfectly fine. But the important thing is you have to have it. I'm battling something right now, and I'll say this is a big issue. If you go the way the rules are now, if there is nothing wrong with your truck, you don't have to fill out the form. Used to be that you had to sign that form every single day. Now you don't have to sign it. So before you had to do that, every single day, every single driver would always turn in a blank form, say, I checked it. Now, by not turning in anything in at all, every single day. You don't have to sign anything. You don't have to do anything. That just certifies that there was nothing wrong with the vehicle that day. You are supposed to fill the form out. You are supposed to complete the form. Under the new rules, completing the form does not require a signature. It doesn't require that you turn it in. It doesn't technically say that you have to do a post-trip, but in order to complete that form, you would have to do a post-trip. So it gets a little confusing because the rule doesn't say you have to do a post-trip. It does say you have to complete the form. And let's say that every day you go through your day, you find a problem and your post-trip, and let's say every day you find a taillight burned out. So every day you go in and you fix it, and you change your wiper blades, you change your headlights, you change your tires, you change your brakes, you do all of these things throughout your week, throughout your months, throughout the year. So at the end of the day, you never have anything wrong. Although you did find that you had a tire bald, you did find throughout the day that you had a light burned out, but you always fixed it. So at the end of the day, you didn't fill out that form. How is it going to look to the inspector that comes in and you have never, in a whole year, never once had to do any maintenance on your truck? Think about that. The DVIR is not an admission of guilt. You're not supposed to drive a truck if you find problems, but you are supposed to notate when there is a problem. So it's an issue if you never fill one out. So just keep that in mind. Always fill that out. A lot of companies make $2.40 a mile plus, then these mega companies make $1 a mile. It's nuts. Similar to the complaint about how brokers are making all this money. If there was a huge spread, if there were companies making all of this money, then there's room for somebody else to come in and cut their throat on it. Somewhere in this thread here, I saw somebody said their cost was $1.60 a mile. I think on average, we're in like $1.69 a mile, I think is average cost to run a truck right now. If you have your own authority and you're paying your own insurance, average about $1.69. If you're leased to a carrier, they pay the insurance and so forth, your cost is lower than that. But let's say that your cost is $1.60, like I saw in the thread. And then you find out that somebody has a contract pulling freight for $2.40 a mile. Why wouldn't you go in there and say, well, I'll do it for $2.35? And somebody else is making $1.60 and they say, I'll do it for $2.30. And somebody else, $2.25, $2.20, $2.80. And that's the way it's going to work. That's why those big companies like Tyson send out an RFQ. They want the best price. They want the service. They want the quality. And they might be willing to pay more if they can guarantee service. There might be something in the contract that says you have to guarantee service. So they might not hire somebody that only has one truck. How do you guarantee service with only one truck? Where if you have 1,000 trucks, you might be able to do that. They're going to look for the best price, the best cost. Cost is more than price. Cost is all of the customer service and everything that goes into it to make sure that there are no claims, are no damages. The freight gets delivered on time, safely, the way it's supposed to. That ultimately puts more money on the bottom line of the shipper, and it comes at a lower cost, regardless of the upfront price. They're going to look for the best cost, most cost-effective option. If it's $2.40 a mile that somebody's making, a broker contracts at $2.40 a mile, and there's another broker that's equally capable, and there's all this capacity out there that's running for $1 a mile, why wouldn't they do that? All right, so Chris brought up something. Well, let me finish my thought on that. So it's a very competitive market. I mentioned earlier, I had 2 full-time people making 50 to 80 calls, fresh cold calls every single day, following up with those in subsequent days thereafter. Email blasts, phone calls, in-person visits, nonstop. I've got multiple businesses here. UDriveU is not registered with my state as a transportation company. People don't really know what it is, so it's an education company. I get calls here often from brokers asking if I have needs for their services. I do. My father-in-law runs a business. He gets calls on a regular basis every single day. on a regular basis offering brokers or carriers offering their services. So if I have the phone literally blowing up, offering a better deal, why would I be paying somebody $2.40 a mile when there's somebody out there that's doing it for $1 a mile? It's not going to happen. It might happen until the contract is up, and then it's not going to happen anymore. There's a big push right now for people getting rid of their authority, going and signing on with these carriers that have contract freight. Well, I tell you that in about 2 months, all those contracts are up for renegotiation. All of them. And then it's all over. Chris says, what about monthly maintenance reports in regards to the DVIR? Do I need to do a DVIR when I do repairs at home? Your monthly maintenance report. So every month you're supposed to turn in a report. This goes back to compliance for all of the work done. And it is actually monthly. FMCSA regulations state monthly. All the work done on the truck. Everything from a truck wash to oil changes, you change a headlight, you change a light bulb, whatever it is, preventative maintenance should all be on there. So Chris says, what about monthly maintenance reports in regards to the DVIR? Do I need to do a DVIR when I do repairs at home? If you're doing your repairs at home, or if you're having them done just normal preventative maintenance, that would not go on a DVIR. Because preventative maintenance is not an inspectable item. So you should have a checklist. The best way to do this, have a checklist of everything that you need to do before you drive. You're going to check your tires. You're going to check your brakes. You're going to check your steering linkage. You're going to make sure all your belts on the engine are tight. You're going to make sure that your lights work. You make sure your brakes, all this, everything. Make sure you don't have leaks. Make sure and so forth. Anything that you find on that type of an inspection goes on your DVIR. Preventative maintenance. One thing that's not on that would be oil change. It's not a requirement to make sure you have fresh oil in your truck before you drive. That's preventative maintenance. So that would not go on there. During a full-blown DOT annual type inspection, which hopefully you do more often, during that type of inspection, things will come up that aren't always caught on the DVIR. It should be noted on the monthly inspection report and so forth. Even truck washes and all that should be on the monthly maintenance report, but it doesn't have to be on your daily inspection report. And how many hours are guys logging on the logbook for repairs at home? That is actually an issue. Chris said that. Chris just started logging all of his home time on duty and then making sure that he takes enough time off duty to make sure that he's never going to be dinged for that. Chris is very diligent about making sure he goes home, he does his maintenance, and he does log all of his time working on the truck actually on duty. He just started making sure that it was that way a couple of weeks ago. He called to tell me that he wanted to make sure he did that to see how it would change the way he works. It doesn't hurt anything. I'm generally off for a week. So Chris goes out for a couple weeks and he goes home for a week. But any time that you are working on the truck, you are supposed to log it as on duty. And Dave pointed that out. Am I a driver or a mechanic? Regardless, if you technically, per the letter of the law, technically, you could have your fancy truck parked in your driveway, be out drinking beer on a Saturday night, and decide, you know what, I'm going to go polish my wheels. And technically, you're supposed to log that as on duty. Anything you do to maintain the truck, wash it, polish it, change light bulbs and windshield wiper blades, fill the washer fluid bottle, change the oil, work on the brakes, tires, what have you. Anything you do, even basic simple stuff, is supposed to be logged as on duty. Does everybody do it that way? Of course not. But as far as compliance goes, and I'll just put on my compliance hat here for a minute. As far as compliance goes, it's supposed to be that way no matter what. When you're building your compliance folders, your driver files, your vehicle files, your maintenance records, and so forth. When you're building all of that, always build that as if you are about to enter a courtroom and go in front of a jury. What will they say? How deep will the prosecuting attorney dig to figure out that you are guilty? So are you at home polishing your truck on duty or off duty? So you get into a fatality accident on a Monday morning, and the officer on the scene notates that you have some nice shined up pretty aluminum wheels. The attorney gets that and sees the pictures and so forth, wants to know, I mean, it was a rainy day the week before, rainy, muddy, how are your wheels shined up? And you didn't log any on-duty time, and you killed somebody. But obviously you were shining those wheels in your off-duty time. So now you're going to prison. You know, it sounds stupid, but this kind of stuff happens, and you see it in these news articles all the time. This stuff happens. Always try to be as careful as you can. Prepare your files and log it as if you're going in front of a jury. If I logged all that nice stuff, logging it cuts into my miles, and I get paid by the miles. No, you don't. You don't get paid by the mile. Nobody in this industry gets paid by the mile. Not if you do it the way Chris does. It makes sense. Correct. You should log all your time working on the truck. Nobody in this industry gets paid by the mile. You get paid to deliver freight. You get paid to go from point A to point B. Yes, it takes time to go from point A to point B, but you get paid to do whatever it takes to deliver that from point A to point B. Is it measured by the mile? Maybe. But is part of delivering point A to point B getting your truck washed or changing the oil? Absolutely. That's part of it. It's all takes part of it. So part of driving those miles is making sure your truck runs. And if you are doing your own maintenance, it should be logged as on duty. You know, I don't, just to make it kind of an extreme example, I don't drive that much anymore. I have my truck still in the yard. I've got several trailers. I use my truck more to just shuttle trailers back and forth to the dealer. And once in a while, I'll go out and take a load, or I'll cover something for somebody. When I do, I have to go spend a good amount of time getting ready. Because, for example, if I go pull one of my reefer trailers, the last time I went out on a long trip, I took a reefer trailer. Or if I want to go pull one of my pad wrap trailers, or if I have a step deck, I go pull a step deck. I have to get that equipment all set up and ready. And it might take me several hours to do that. So if it takes me half a day to get ready to go, and then I hit the road, I'm not going to be able to drive all night long before I start getting fatigued. And if I was to start getting fatigued and I got in a fatality accident and they come back, it would be pretty easy to look at my operation and see what I'm doing. As a matter of fact, even my office time, when I'm here right now, I'm supposed to log this as on duty if I was to go get in the truck right now. All right. That being said, we are a lot later than I needed. I am going to start doing these shows again. Hopefully I can get the bugs worked out of YouTube here and get the Blog Talk Radio back up and running. That being said, I'm going to try to start doing these shows weekly again every Tuesday. So spread the word. Trucking with Authority is back. We are rebranded completely You Drive You Network. I'm going to keep the Trucking with Authority show will be Tuesday nights, but You Drive You is going to be all of my training events and all of my recorded training videos. But the Trucking with Authority show will remain a call-in type show. Let everybody know we're back, and I will talk to you all next week. Have a good night, everybody.